Today, we're diving into The Behavioral Investor by Daniel Crosby. And trust me, you'll discover why your brain is wired to cost you money, and more importantly, how to outsmart your own brain. By the end of the video, you'll know the number one behavioral bias that even the most seasoned investors fall victim to, and how you can protect yourself from it. Make sure to hit that subscribe button to receive new videos each week on personal finance wisdom. Let's get started. Lesson 1. The 4 Pillars of Investor Behavior. Crosby's book introduces us to 4 pillars that shape investor behavior: sociological, neurological, physiological, and psychological. Each one plays a crucial role in why we make the decisions we do. In one jaw-dropping example, Crosby talks about how traders were shown real-time stock movements while neuroscientists scanned their brain activity. The result? Their brains reacted the same way as if they were being chased by a predator. Your brain doesn't distinguish between a bear in the woods and a bear market. That fight or flight instinct kicks in, making it almost impossible to stay rational. It's why so many people panic sell in a downturn, even when they know it's probably the worst thing to do. Lesson 2. Herd mentality. The danger of following the crowd. Now, let's talk about one of the deadliest behavioral traps: herd mentality. We've all been there. You see everyone rushing to buy a hot stock, and even though you don't fully understand it, you jump in because, well, FOMO, fear of missing out, right? One of Crosby's most powerful examples comes from the dot-com bubble. Investors were pouring money into companies that had no profits, no real products, and in some cases, no revenue, just because everyone else was. Crosby explains that this isn't just a historical anecdote, it's a recurring problem. Whether it's the dot-com bubble or the recent cryptocurrency mania, the crowd makes us feel safe. But in reality, it often leads us off a cliff. And here's the kicker. This bias doesn't just affect amateurs. Even seasoned professionals fall for it. And later in the video, I'll reveal how one of Wall Street's most successful hedge fund managers lost billions by following the herd. You won't believe who it is. Lesson 3. Overconfidence. The silent killer. Next up, let's dive into overconfidence, a sneaky bias that gets even the best of us. Think about it. When you make a winning trade, you start to feel invincible. But Crosby warns that the more confident you get, the more dangerous your decisions become. Crosby highlights a stunning study conducted with professional investors where they were asked to predict the stock market's direction. Spoiler alert, they were wrong over 50% of the time. But here's the twist. Despite their failures, their confidence didn't drop. Why? Because we humans have a psychological tendency to focus on our wins and conveniently forget our losses. This bias is so ingrained, Crosby points out that even legendary investors like Bill Ackman fell victim to it. Ackman's overconfidence in the marketability of a particular stock led to his infamous multi-billion-dollar loss. In 2015, he placed a huge bet on Valeant Pharmaceuticals, in part because other big names were jumping in. What happened next? Valeant stock plunged, and Ackman's fund lost over $4 billion. Even the smartest in the room can be blinded by their own brilliance. Lesson 4. Loss aversion. Why losses hurt more than gains feel good. Now, let's talk about pain. Not physical pain, but financial pain. Crosby explains a fascinating concept called loss aversion, the idea that losses hurt twice as much as gains feel good. In one of the most revealing studies Crosby discusses, participants were offered a choice. They could either receive $1,000 outright or take a gamble to potentially win $2,000, but they could also lose $500. The majority chose the guaranteed $1,000, even though the gamble statistically had a better payoff. Why? Because the thought of losing money was too painful, even if it meant missing out on larger gains. This explains why investors tend to sell winners too early and hold on to losers for too long. Crosby points out that during the 2008 financial crisis, countless investors cashed out in a panic at the bottom of the market, which locked in their losses. Those who stayed patient and kept investing saw massive gains in the years that followed. Lesson 5. Decision fatigue can wreck your portfolio. This next bias might shock you because it doesn't just affect your money, but your entire day-to-day life. It's called decision fatigue. Crosby reveals that the more decisions we make throughout the day, the more likely we are to make bad ones as time goes on. Crosby shares a study about criminal judges who grant parole. Early in the day, they grant parole around 65% of the time, but by the end of the day, that number plummets to near zero. Why? Decision fatigue. And the same goes for investing. Imagine you're an investor making hundreds of decisions throughout the day. By the time the closing bell rings, you're drained. Crosby argues that this fatigue leads to impulsive decisions such as panic selling or impulsive buying. So how do you protect yourself? Crosby's advice: automate as much of your investing as possible. Set up systems that make decisions for you, reducing the risk of fatigue-fueled mistakes. You can also make a deal with yourself to only look at your portfolio when you are fresh and well-rested. Lesson number 6. The long-term mindset, the ultimate investor's weapon. Finally, the antidote to all these biases is long-term thinking. Crosby argues that the most successful investors are those who tune out the noise and focus on the bigger picture. Crosby uses a brilliant example of Warren Buffett, who famously invests with a long-term mindset. Did you know that most of Buffett's wealth was accumulated after his 50th birthday? Patience and compound interest worked their magic. While others were chasing quick gains, Buffett held onto companies like Coca-Cola for decades, reaping the rewards long after others had moved on. The lesson here: stop obsessing over daily market swings. The market will reward you if you stay the course. As Crosby says, the best investors are those who do less but think more. Lesson number 7, the shocking bias even billionaires fall for. Now, as promised, let's talk about the bias that even the richest, most experienced investors can't escape. Recency bias. This is the tendency to overemphasize recent events and let them distort your long-term perspective. In 2008, after a string of bad investments, billionaire investor Carl Icahn sold a massive chunk of his portfolio at the market's lowest point, convinced that the financial crisis would last for years. But just months later, the market began to recover, and those who stayed invested saw incredible gains. Even the great Carl Icahn, one of the world's richest men, let recent events cloud his judgment. Conclusion: outsmart your brain. Outsmart the market. What's the key takeaway from the behavioral investor? The biggest threat to your wealth isn't the market. It's your own brain. By understanding these biases and putting systems in place to counteract them, you can become a smarter, more successful investor. An investor that runs on logic rather than emotion. In the comments below, tell us about a bad decision in the market that you made. Let's all learn from each other. And if you want more deep dives into the psychology of investing, hit that subscribe button for new videos coming out every week. Thanks for watching.